Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, May 1st, 2019. As we start off the month, and now that we have all the five FANG stocks out of the way as far as our earnings reports go, we can kind of turn our focus a little more to individual stocks. And also, an added benefit is, for the most part, we're over the hump for earnings season. Now, it's certainly not over, but a lot of the big names have already reported. The big market movers, the bulk of those are out of the way. We'll still have to navigate some individual stocks, but at least now, as far as surprises for what the broad market might do, I think that's been taken out now. So we can start to turn our focus here, maybe start to engage some more trade ideas, both individual stocks and or sectors in the market. Now that, like I said, the earnings season is kind of, at least the hump is over. QQQ. All right, let's start out here. Again, big news last night was Apple. Again, to quickly rehash, yesterday we had a breakdown, but of course it was not impulsive, and it occurred right in front of Apple's earnings. So therefore, it really, something you shouldn't put a lot of stock into. But now let's turn our focus to the charts now that now that Apple's out of the way. What it was is a breakdown, and so now we're looking at a back test or a near back test on QQQ. I also posted this chart in the trading room last night. This is the NQ Nasdaq 100 E-mini futures. So here's that trend line off the lows on December 24th. Very well defined trend line. We had a breakdown before Apple reported yesterday, and then a kickback. Now, last night in the trading room I posted, and again this morning I posted we were back testing yesterday or close to it after Apple reported, and this morning that we were back testing starting to roll over. So I will say this emphatically. I think this is I can tell you I think it's an objective entry. It is somewhat aggressive because we don't have the tech sector breaking down yet. XLK is above trend, but we do have QQQ breaking down, and even though that breakdown was suspect yesterday because of Apple having yet to report, sometimes you take the charts for what they are, and that's what this is. It's a breakdown and a back test, and we're starting to roll over. So whether or not I add this QQQ as an official short trade, that's up to you. I've given targets. I'll go over those in a second again here, but I wanted to say this is a pretty clean breakdown. This was a little whipsaw signal that was brief. This was a little bit more, and the fact that we've now back tested and rolling over, and again, it's all about objectivity. If you short it, then at this point you've already back tested. You can set a stop relatively high. If you want to quantify it, which you always should do if you do decide to take this trade, or any trade, you're looking. These are the two targets I have on NQ. If you're a futures trader, that's about a 3.61% drop, and if we get down here, that's about a, where did it go, 7% drop. So therefore, you pick your target, your preferred target, and you set a stop in line with your price target. And, general rule of thumb, I like to use a 3-to-1 or better RR, risk reward ratio, meaning I'll risk a dollar to make three. Depends on the trade too. You can sometimes have it a little tighter, sometimes more looser. Different RR, but that's a rough RR. So that gives you an idea of where to set your stop above. And again, if I didn't like it, I wouldn't be going over it right now. And I may very well add that on as an official trade here. There's the chart. If I cut off some of that before, I didn't realize that chart wasn't centered. So there it is for you NQ traders. QQQ. Same story. I've shared those charts or the targets recently on this 60-minute right here. Potential targets. Those were on the front page yesterday as well as last week. And again, if you look at this QQQ chart, here's the move off the lows on December 24th, and a very clean up trend line, breakdown and back test. But again, not very impulsive. So my convictions aren't super high right now. They're not very high because of the fact it wasn't an impulsive breakdown. What would help to see is a rejection here and an undercut of the recent lows. I can tell you that. So if you're interested in this, if you haven't given up on the fact that this market may have a decent correction here, pretty sharp and fast correction, I think if we get it, that would be another level for you to wait to see that taken out, those recent reaction lows right there. And that's about 188.64. So. Okay, and the things give me pause, at least adding that as an official trade. Well, here's Apple. Apple's gap back up, after that breakdown yesterday, which I said you'd have to take that with a huge grain of salt because it occurred right before earnings. And again, this is just why you don't take breakdowns immediately before stock reports, or breakouts for that matter. If Apple can hold that level, hold above that trend line, great. And then we'll probably have to just revise this trend line, maybe come in and capture these reactions here. But let's see what happens. A day is young. It usually takes a day or so for the market to digest a company's earnings report and see which way they want to go with it. If Apple continues higher, 216.41 is a resistance level to watch. That was the bottom of this topping type basing pattern here, right here. There's the line that I'm looking at. That's where Apple kind of peaked out, traded around for a few months, and then finally broke down. So that should come into play as a resistance there, about 216.41 or so, if Apple continues higher. If it reverses, then look for a breakdown. We'll keep this trend line like this for now. Look for a break of that trend line and a pulse of break, and this may prove to be just a post-earnings whipsaw signal. So that's Apple, but again, tech sector has not given up the ghost yet, and will need to. There's the trend line off the lows on the 24th, and again, we've had a couple intraday breaks, but not a breakdown yet. So I'm still waiting for that. If and when that comes, we'll probably see some shorts on either the Qs and or the tech sector or individual tech stocks. Let's see, including the semis. All right, let's show you some things for long side trade ideas. A couple days ago in the trading room, I posted, let's find it here, natural gas setting up. Natural gas had a couple things that I like about it. We had, number one, pretty strong, and this is a daily time frame, by the way, on nat gas futures, NG. Pretty strong bullish divergences at the low. We were very oversold right here. You can see the deep oversold readings. Last time we were that oversold was right here. You can see what happened there. If you're an NG trader, I don't have to tell you how much. That's thousands of dollars, probably 10 grand or more in your pocket per contract. NG, that sucker can move, and it's pretty highly leveraged. I think there's a mini contract too, if I'm not mistaken, for natural gas. If you're not comfortable with the big contract. Anyways, this is the big contract being the Henry Hub. All right, this is the level I'm watching. So the other thing I'm seeing besides the divergence, $2.52.8, 2528. It was a pretty important support level. As you can see, we're going back years. Here's all the way back to 2015 right here. Here's the 2015 mark. And what I'm going to do is put that line there and show you just how many times nat gas has kissed that level. Many times. So it is a very important level. These are all reactions from above, below, most from above. That was close to it. And as you can see, that is unarguably a very important level for nat gas. Now what I like about it, as I often say, fewer things in trading and investing are more bullish than a failed breakdown. That was a major support level, multi-year support. We took it out recently, which on face value is bearish, but as I often talk about, same thing with new highs in the market and other things like that. Breakout to new lows or multi-year lows like this that occur with positive divergence, bullish divergence, and oversold. Remember, just flip that over for the stock market right now, breaking out to new highs, so I overbought with negative divergence. That's a breakdown that I don't short. But many do, because they don't see those things. They see, break of support. So this is what we call a bear trap, aka false breakdown. So the shorts see that, the longs get stopped out, shorts pile in, but then when you recover and regain that level, there's a potential there for a short squeeze, and that's why they call it a bear trap. The shorts might pile in. Either way, whether a ton of shorts went in or not, I don't know, but that's typically how it works in technical analysis. All I know is we've recovered that level. Since I pointed out, nothing big, but nat gas continues to move steadily higher since. It's up another 1.5% today, and you can see my targets are the horizontal lines. These two are the ones I'm focused on right now, these two lines here, about 270.25. 725 and 2914 or so. That'd be my preferred swing target right now at this point in time. Possibly more, we'll see. I'm still very much watching silver and gold. Haven't pulled the trigger yet, but getting close to it. I've had a couple in and out trades gold recently, but I'm looking to position probably go with silver. I mentioned, as I mentioned recently, I like silver for a few reasons right now. Now it needs to hold on to this level because this was a huge, very important basing pattern here, this W-type pattern. We broke out, and as I mentioned recently, we came in and back tested. It's around the $14 level. We're cracking a little below it, but you can see these are choppy little candles, and silver ETF tries to track silver futures. But so you have a couple things going on. You have silver down to support. You have a bullish falling wedge pattern confirmed with positive divergence. We need a reversal in the metals, and for that we need the dollar, US dollar, to break down a reverse trend. I'll get to that in a second. So there's silver. Gold is in a similar pattern. You don't have divergence, but that's fine. You don't always have to have divergence for a reversal. I have some lines on this chart. Let me grab those. There we go. So you can see same similar type pattern, wedging type. Not a super well defined downtrend line, and again, no divergence there. But gold has been holding this support level about 120. That's a crooked line. Look at the horizontal line there. If it continues lower, I'll keep watching it, and maybe the next buy op will be all the way down here, 117.40. So I keep highlighting this. It's like anything else, a trade setup, not an actionable trade right now. Long-term investors might want to scale in. I have a pretty high degree of confidence we'll eventually get a reversal here soon. Here's my euro US dollar. This is a daily chart, and as I've been saying, this is what I'm waiting for confirmation to jump into gold and silver. We have a downtrend line forming this wedge type pattern, big divergences. They're so big here on this daily chart, you almost have to go out to the weekly to really see it clean. So there's your falling wedge. We're at a support level now, midpoint here, about that 11,240 level on the euro US dollar. For those of you that don't track the euro US dollar, another option is UUP. That's a US dollar index, or you can get the actual index itself. But this is the euro US dollar pair in reverse. And so where there you have a bullish falling wedge, you have a bearish rising wedge type pattern, at least the negative divergence you can see spanning for a while. It's been building. It's not as if these divergences don't play out. They usually do. There's divergent high 1, correction, divergent high 2, correction. This is just simply an extension of the divergence that began back here. And so this is the trend line I'm waiting for a breakdown. This is an uptrend line off the lows. That would be a major sell signal for the dollar, major buy signal in gold. And so I think it continues to warrant monitoring both the dollar, gold, silver, all that, because we could be looking at a pretty powerful swing or even trend trade coming up in those. Crude oil, as we know, this is an active trade as of yesterday. Breakdown back test, and it's moving lower today. So far so good, but I'd like to see an impulsive rejection. That would certainly help. And the thing about it, like any other trade, I have trade parameters. You guys can use your own trade parameters. Everything I throw out there are just suggestions. This is what I see, and where I think objective targets and stops and things like that. But ideally, you'd want to see a breakdown here in an impulsive move down. But what I was getting at is, with any trade, I enter trade. I love the use of OCO orders. I've talked about that in the past. If you're new to the site and you're not familiar with how those work, it's one cancels the other, or one cancels another. Sometimes they're referred to as OCA. There was posts I've made about those. Basically, you enter a trade. So let's just talk on USO, for example, real quick, not to get off track here too much. But there's the USO trade. Where was that? Here we go, right there. You can see the long-term trend line broken, back tested, a little flagging type action here. So wherever that was entered yesterday, somewhere around here, I don't think, I'm probably about flat on it. And here's the targets. What you do with an OCO is the minute you buy the trade, you turn around and you set two orders at your broker. They're tied together. One cancels the other. You set your stop loss wherever yours is. This is where the official stop is on the trade, and you set your buy to cover. This is a short trade, so you set your buy to cover orders wherever they are. Some people might want to take partial profits along the way. Some might only be targeting this level here. Some might be targeting the final target. So that's how an OCO works. And what happens if USO were to go up here and get stopped out? That order triggers. You're out of the trade. No second guessing it. If nothing else, if not the convenience of not having to monitor and watch that, it's the discipline it gives you. And I think that's where probably the bulk of people listening to my voice, and myself included, sometimes I'll struggle with discipline on trades, second guess something. When you do these, you don't second guess it. That's your stop. Your loss is quantified from the minute you enter the trade, and it's going to do one of two things. It's either going to hit your price target or it's going to hit your stop, but you're not going to second guess it. My point is, let your trading plan work. If you go into a trade, unless something compelling changes, I find it best to just stick with your trading plan and not mess around with it. Don't second guess it, because goodness knows this market or any market will do that to you. It'll make you second guess your positions, and if you entered it for a solid reason, again, unless something compelling changes in the charts, just let it work out, and the OCOs are a great way to do that. All right, just want to talk about one thing, see if there's any other trade ideas. I have quite a few, by the way. I have a growing watch list of trade ideas that stand out. Individual stocks, a lot of those. Some sectors, I'll get you one more sector, and then I want to talk on something on U.S. Well, let's start there first. Okay, so you see this big recovery in crude oil. Still well off the highs, but the drop, as I talked about, it mirrored the stock market. It was just in nearly twice the scope. In other words, the stock market dropped a little over 20%. USO dropped a little over 40% off the highs. The stock market rallied 20-something percent. USO rallied 50% off the highs. But still, it didn't retrace, but that's a 50% rally. So where I'm going with this is, I've been watching the energy stocks lately. So this is still an impressive rally, 50% in just a few months there, and yet what's going on with the energy stocks? Why are the energy stocks kind of sucking wind here? This is XLE, the biggest of the energy sector ETFs. This for the most part is the component of the S&P 500. This ETF, this energy sector, about a 5.5% weighting. But you also have a couple other niche energy sectors. XOP, oil and gas exploration and production ETF. That is just starting to crack today below this wedge. And then you have XES. So where I'm going with this, XES is just really had a clean uptrend line. See this nice little wedge, negative divergence. This was a beautiful setup. I didn't take it at the time because oil was still pushing up to new highs, and it just didn't make sense. But even now, oil's still right at the highs, by the way. I'm trying to catch a top on it. Maybe that trade works out, maybe it doesn't. But why has XES, this sector, the oil and gas equipment and service sector, dropped now, plunged 13% in just the last few weeks when oil's screaming? It doesn't make sense. And here's the thing. The energy sector is a very large component of the junk bond market. They've issued a tremendous amount of debt, and a lot of these companies are just very, very on the edge, fundamentally speaking. So as I go through the charts here of XES, the top components, I'll just rifle through them real quick. You can see Schlumberger, and there might be trade ideas. So I'm doing this for two reasons. As I'm looking at it, I see a lot of these stocks, getting beat up recently, Baker Hughes, but look at these slides. And it makes me think, well, what's going on? If they're not making money on a 50% rally in oil off the lows. Okay, so here's where NOV is after a 50% rally in oil. What's going on? There's something. It's just a sector that I'm monitoring right now. Maybe it's an aberration, some kind of temporary thing. Some doing better than others, but a lot of these stocks you can see rolling over as I go through the charts, and not very far off their lows back in December. This is not a good sign, I don't think, especially for the junk bond market. That's where I'm going. Junk bonds are rallying, and they're not far off their highs. They're back to about where they were before the whole thing melted down before. And the junk bond sector, and you can trade it via JNK or HYG, is buzzing along. And I think that's a large part, a lot of people chasing yield. Either way, something to monitor, because if there's something going on in the energy sector and some of those stocks continue to implode, that should put pressure on the high yield bond market, and that's not really being reflected yet. So just a potential development I'm watching. You can see here I have a HYG starting to crack below this trend line. Nothing impulsive yet. Keep in mind too that junk bonds trade much more in line with stocks than they do the other bonds. TLT, which is a government bond ETF, and HYG, junk bond ETF, have very little to do with each other. TLT government bonds are more interest rate sensitive, whereas HYG and JNK, the junk bonds, they are more economically sensitive, because if the economy turns down, you see default rates start to go spike, and that's the biggest driver, if you will, the prices of junk bonds is how the economy is doing. So just one to watch, potential trade idea, and it's also a potential tell on the economy too, if we start to see some problems in the high yield bond market. Another sector I'm watching, this was one I was, one of the official trade ideas, I believe, and I was very bullish on this one. It was one of my favorites back at the lows in December and into January. The home builders. We used ITB at the time. They're almost identical. ITB, I think, has just a little heavier weighting on actual home building stocks. They all have a mix of everything. They're not pure play on home builders. For example, XHB, which is probably the more liquid of the two. The top holdings in there are Home Depot and Lowe's. So obviously Home Depot and Lowe's aren't building houses, but they benefit from the housing market. I just want to point that out. And so what I'm watching here is this nice little wedge type pattern forming. Yeah, I had a line here. We broke out and back test, or just broke out. Let me tune that down a little. This is what I'm watching right now. So in fact, that's the fit that I like right there. So we see a breakdown, a back test, divergent high. So this is on my radar as a potential shorting up. There's also quite a bit of resistance you can see as I put a horizontal line. That's really, this area here is where prices were capped throughout most of 2018 after a little blow off top right here back in early 2018. So here's a sector that may be still, it's possible, in the early stages of a bear market. Maybe this was just a correction. Only time is going to tell. Was that a correction with more to come, or the initial leg down of a bear market, I should say, with more to come, or was this just a correction like this one here in an ongoing bull market? Again, we all have our opinions. I'm not sure, but I can tell you right now, these are getting stretched. This rally is stretched, and the technicals are telling me that we'll probably get a reversal. So I'm going to start sniffing out some of the individual home builders and or related stocks, Owens Corning, Lowe's, Home Depot, things like that, and or maybe this sector ETF, and see we might have a trade, some trading ops here soon. Let's wrap it up here. Again, I just wanted to cover kind of broad sectors and commodities, things I'm watching. And that's some of those right now. And here's QQQ. We'll just come back to there. Still testing that trend line from below, up right now. Like I said, not yet. I don't yet have the comfort level to add this as an official trade. One of the other things I'd like to see this trend indicator, the PPO signal line on the 60-minute chart, cross down below zero. That would certainly help to support it. And again, an impulsive rejection off the back test of this trend line, and come in here and maybe take out the recent lows. Those are things that we'll be watching for. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.